I need you to stop everything right now, because what this channel is about to show you is not a price prediction, not a speculation about what Bitcoin might do, and not an argument about whether institutions are coming. What I am about to show you is a verified arithmetic problem, a documented collision between the most specific, most measurable institutional demand catalyst in Bitcoin's history and the most constrained, most structurally depleted liquid supply Bitcoin has ever had. And when you run the actual numbers, sourced from the SEC's own filings, from Morgan Stanley's own earnings report, and from on-chain data from Glassnode and CryptoQuant, the conclusion is not comfortable. It is that 1% of Morgan Stanley's clients allocating to a single ETF that goes live tomorrow produces a demand number that is larger than the entire liquid Bitcoin available for purchase at current prices without moving the market. On January 6, 2026, Morgan Stanley filed an S-1 registration statement with the U.S. Securities and Exchange Commission for the Morgan Stanley Bitcoin Trust. The product, which will trade on NYSE Arca under the ticker MSBT, has since been through 6 amendments. The most recent, Amendment Number 6, filed April 3, 2026, confirmed by this channel's direct reading of the SEC filing, establishing the final structure of a spot Bitcoin ETF that holds Bitcoin directly, tracks the CoinDesk Bitcoin benchmark 4 p.m. New York settlement rate, charges a 0.14% annual management fee, uses Coinbase Custody Trust Company and BNY Mellon as dual Bitcoin custodians, and names Morgan Stanley Investment Management as the delegated sponsor. Bloomberg senior ETF analyst Eric Balkunas posted a screenshot of the NYSE Arca listing notice and stated publicly that the fund looked set to go live on April 8, 2026, tomorrow as of this recording. Crypto Briefing confirmed the SEC declared the registration effective and Morgan Stanley filed its final prospectus. This is not another spot Bitcoin ETF joining a crowded field of 11. Every existing U.S. spot Bitcoin ETF, BlackRock's IBIT, Fidelity's FBTC, VanEck's ODL, Bitwise's BuyTB, every single one of them, was created by an asset management company that then had to convince external financial advisors at other firms to recommend it to their clients. BlackRock does not own the client relationship. Fidelity does not own the client relationship. They build products and distribute them outward through networks they do not control. Morgan Stanley owns the client relationship, $17 trillion worth of assets, in the hands of approximately 16,000 financial advisors who sit in private offices with the wealthiest individuals and institutions in America, according to the Blockchain Council analysis, citing Morgan Stanley's data and confirmed by CoinCentral's coverage of the filing. When Morgan Stanley creates MSBT, it does not need to convince anyone to recommend it. It tells its own people to offer it to their own clients. The product travels from creation to recommendation without ever leaving the building. The fee structure confirms the strategy. At 0.14% annually, MSBT is the lowest cost spot Bitcoin ETF on the U.S. market, confirmed by CoinDesk's March 27th report, Crowdfund Insider, and the SEC filing itself, which notes it undercuts the previous low of 0.15% charged by Grayscale's Bitcoin Mini Trust and sits well below the 0.25% charged by BlackRock's IBIT and Fidelity's FBTC. A lower fee removes the conflict of interest calculation for Morgan Stanley advisors, who were previously recommending third-party products that generated better economics for external fund companies rather than their own employer. CoinDesk's analysis noted directly, because spot Bitcoin ETFs offer nearly identical exposure, Morgan Stanley's lower fee could prompt advisors to shift client assets from higher cost funds. This is not just a competitive pricing move, it is the systematic removal of every internal barrier between 16,000 advisors and the act of recommending Bitcoin to their clients. On January 15, 2026, Morgan Stanley reported its fourth quarter and full year 2025 earnings. The headline number for this channel's analysis is contained in the Wealth and Investment Management segment. Total client assets climbed to approximately $9.3 trillion at the end of Q4 2025, up from $8.9 trillion the prior quarter. Financial Planning confirmed this figure and noted it put Morgan Stanley well on the way to attaining a $10 trillion asset goal set under former CEO James Gorman. Wealth management net revenues were $8.4 billion in Q4 2025 alone, up 13% year over year, representing a quarterly and annual record according to wealthmanagement.com's coverage of the earnings. The specific figure that drives the supply shock calculation in this video depends on which component of those $9.3 trillion is actually accessible to the MSBT distribution network. Different sources use different figures depending on whether they include the investment management division or focus purely on wealth management. Blockchain Council's analysis, sourced to Morgan Stanley data, cites approximately $6.2 trillion managed by roughly 16,000 financial advisors, the figure that most precisely represents the assets that advisors can actively recommend into. BitGet's analysis uses approximately $8 trillion as the relevant base, consistent with strategy CEO Phong Le's public calculation on X. Morgan Stanley's official earnings report, which this channel read directly, confirmed $9.3 trillion as the total wealth and investment management figure for the combined division. This channel will use the conservative figure of $6.2 trillion, the advisor-managed base confirmed by Blockchain Council and CoinCentral, for the core calculation and show what happens at higher allocation levels using the broader base. One more data point before the calculation. Morgan Stanley Wealth Management announced in March 2026, confirmed by Business Wire, that it had surpassed $1 trillion in individual retirement account assets under management, a threshold achieved for the first time ever. This matters for the Bitcoin allocation thesis because IRA assets are among the most tax-advantaged channels for Bitcoin exposure. And since October 2025, Morgan Stanley has authorized its financial advisors to recommend Bitcoin ETFs to all clients, including those with retirement accounts, not just high net worth clients with aggressive risk tolerance. BitGet's analysis documented this directly. Since October 2025, Morgan Stanley has authorized its financial advisors to recommend Bitcoin ETFs to all clients, including those with retirement accounts, IRAs, 401ks. Previously, access was limited to high net worth clients with aggressive risk tolerance. The permission is already in place. The product is being launched. The only thing that was missing was a proprietary vehicle, and MSBT is that vehicle. This block will do the math precisely from multiple starting points, using only documented and verified figures. This is not speculation. This is arithmetic applied to public data. 1% of $6.2 trillion equals $62 billion. 1% of $8 trillion equals $80 billion. 1% of $9.3 trillion equals $93 billion. For context on what those numbers mean in Bitcoin market terms, BlackRock's IBIT, the product that Bloomberg senior analyst James Seifert described as the greatest ETF launch in history and the fastest to $50 billion in any asset class ever, accumulated $63 billion in cumulative net inflows over its entire first year of existence, from January 2024 through December 2024, according to CoinDesk's November 2025 report. The entire U.S. spot Bitcoin ETF market holds approximately $83 to $90 billion in combined assets under management as of April 2026, based on CoinDesk's daybook data and FEMEX's analysis. A 1% allocation from Morgan Stanley's conservative $6.2 trillion advisor base produces demand of $62 billion, equal to IBIT's entire first year of inflows, from a single institution in a single allocation decision flowing through a single proprietary channel that has zero distribution friction. Strategy CEO Phong Lee posted his calculation publicly on X after Morgan Stanley's March 20th filing, documented by Bitcoin Magazine. Morgan Stanley Wealth Management oversees about $8 trillion in AUM and recommends 0 to 4% Bitcoin allocation. A 2% allocation would represent $160 billion, about 3 times the size of IBIT. MSBT, Monster Bitcoin. Lowe is not a neutral observer, but his arithmetic is sound, and this channel does not need to use his 2% figure to make the point. This channel's conservative 1% calculation against the advisor-managed $6.2 trillion base already exceeds the entire first year of IBIT inflows. The question is not whether this number is large. The question is whether the Bitcoin market has enough liquid supply to absorb it. If you're still with me at this checkpoint, I want to recognize your intellectual stamina. Most people have already scrolled away to a 60-second clip, but you are here for the deep architecture. You've just outlasted 90% of the market. To help me calibrate how far the signal is reaching today, I need you to do something. Comment your city, your local time, and the current weather where you are. It sounds simple, but it's a data point for me to see the global distribution of the engineered markets community. You've earned your place at this table. This is the block that turns a large demand number into a supply shock thesis, and this channel will present the on-chain data with the precision it deserves. Bitcoin has a fixed maximum supply of 21 million coins, hard-coded into the protocol by Satoshi Nakamoto in 1929, and confirmed by the consensus mechanism that has run without interruption for over 15 years. As of April 2026, approximately 19.8 million Bitcoin have been mined, meaning roughly 94% of all Bitcoin that will ever exist is already in circulation. The 2024 halving, which occurred on April 20th of that year at block height 840,000, reduced the daily issuance from 900 Bitcoin per day to approximately 450 Bitcoin per day, confirming the protocol's progression toward absolute scarcity. Of those 19.8 million mined coins, a substantial portion is permanently unavailable. BitGo's analysis, sourcing and Glassnode data, estimated that the effective circulating supply available for trading is likely between 15.8 and 17.5 million Bitcoin once lost coins are accounted for, with blockchain analytics firm Chainalysis estimating approximately 3.8 million Bitcoin are permanently lost to forgotten keys, hardware failures, and deceased holders who left no estate planning. That means the true accessible supply is not 21 million coins. It is not 19.8 million. It is somewhere between 16 and 17 million, with roughly 3 to 4 million coins gone forever, according to multiple independent analyses including BitGo, CCN, and Bleep Finance. Illiquid supply, coins that haven't moved in over 12 months and are held by long-term investors, has grown to represent approximately 70% of circulating supply, according to BitGit's analysis from early 2026, with Glassnode and ETC Group tracking illiquid supply at a record 74% of circulating supply as of September 2024, and CoinDesk confirming the illiquid Bitcoin entities now control a record share of total supply. The exchange reserve data tells the most operationally significant part of the story. CryptoQuant's data, confirmed by Spotted Crypto, the Crypto Times, Femex, and Coinpedia, shows Bitcoin exchange reserves declined to approximately 2.21 million Bitcoin as of March 2026, described by Spotted Crypto as just 5.88% of total circulating supply, the lowest since December 2017. The Crypto Times confirmed Bitcoin exchange reserves have reached an all-time low, with on-chain data indicating a drop to between 2.43 and 2.7 million BTC as of March 10, 2026. This marks a significant decrease from over 3.2 million in 2023. The contraction of nearly 1 million coins from exchange reserves in under 3 years, while the total mined supply only grew by approximately 330,000 coins through new issuance, means the available supply is shrinking faster than new supply is being created. The supply side of the Bitcoin market is in a structural squeeze that has been building for years and is now at its most extreme point in the asset's history. Before MSBT receives its first dollar of client allocation, 3 simultaneous forces have already been consuming Bitcoin's available supply at scale, and this channel will document each one with specific verified numbers. Understanding the baseline consumption is essential for understanding why adding MSBT's potential demand to the existing system creates a supply shock rather than simply another ETF competing for flows. Force 1 is the existing ETF market. The 11 U.S. spot Bitcoin ETFs collectively hold approximately 1.3 million Bitcoin, according to Coinpedia's analysis, representing roughly 6 to 7% of Bitcoin's circulating supply. These coins are held in custodial cold storage, Coinbase custody, Fidelity digital assets, BitGo, and they do not return to exchange order books unless investors redeem shares. CoinDesk's data confirmed total U.S. spot Bitcoin ETF AUM was approximately $90 billion as of early April 2026. While net cumulative inflows since January 2024 had exceeded $56 billion according to multiple sources. Every dollar that flows into a spot Bitcoin ETF requires the fund to purchase actual Bitcoin from the market and lock it in cold storage. The ETF market has already removed over 1 million Bitcoin from the tradable supply and continues removing more with each positive flow day. Force 2 is corporate treasury accumulation led by Strategy, formerly MicroStrategy. Strategy holds 762,000 Bitcoin as of April 2026, purchased at an average cost of approximately $75,694 per coin, according to CoinDesk's tracking. In Q1 2026 alone, Strategy added 89,618 Bitcoin, confirmed by Cointelegraph as the company's second biggest quarter of accumulation ever. On April 6th, the day before Trump's Iran deadline, Strategy added another 4,871 Bitcoin, confirmed by FX's Street, representing approximately $330 million, deployed in a single day during extreme fear conditions. Collectively, corporate treasury entities now hold approximately 1.1 million Bitcoin according to Coinpedia, representing about 5% of circulating supply, and this channel has documented across multiple prior videos that these entities operate with explicit long-term holding mandates, meaning their Bitcoin almost never returns to exchange order books. Force 3 is the halving cycle. The fourth Bitcoin halving occurred on April 20th, 2024, at block height 840,000, confirmed by the Block, CoinGecko, and iShares' own research paper. Daily new Bitcoin issuance fell from approximately 900 Bitcoin per day to approximately 450 Bitcoin per day. In annual terms, the total new Bitcoin entering the market through mining fell from approximately 328,000 Bitcoin per year to approximately 164,000 Bitcoin per year. At the current Bitcoin price of approximately $68,000, The entire annual new supply from mining represents approximately $11.2 billion in new Bitcoin per year. Against $62 billion in potential MSBT demand from a single 1% allocation, the entire annual mining production is less than 20% of the 1% scenario. The halving did not just slow issuance. It created a mathematical environment where any significant institutional demand event that occurs in 2025 through 2026 operates against a supply backdrop that cannot respond by simply mining more coins. This block is the core thesis, stated with the precision that the data permits and with the intellectual honesty that this channel always applies to both the bull case and the bear case. The on-chain data establishes that Bitcoin exchange reserves are approximately 2.2 to 2.7 million Bitcoin as of early April 2026. Not all of that 2.2 million is freely tradable. A significant portion is held by market makers, OTC desks, prime brokers, and custodians as operational float rather than available sell-side inventory. Coinpedia's analysis of the dynamics noted that when exchange reserves drop, the immediately tradable supply contracts significantly, because not all exchange-held Bitcoin is available at current prices. Bickett's analysis confirmed, if demand remains constant or increases, prices must rise to clear the market. This effect intensifies during halvings, when new supply issuance cuts in half every 4 years. The on-ramp Bitcoin research analysis, dated March 26, 2026, and cited in the document this channel was provided, calculates the demand scenario precisely. 0.5% allocation equals greater than $30 billion, approximately 430,000 Bitcoin. 1% equals greater than $60 billion, approximately 850,000 Bitcoin. Welcome. 850,000 Bitcoin at current prices represents approximately 39% of the total exchange-held supply of 2.2 million Bitcoin. The demand from a single 1% allocation decision by Morgan Stanley's advisor network, if executed over a reasonable deployment period, would require the purchase of 850,000 Bitcoin, 850,000 coins, from a pool of 2.2 million that is already the lowest it has been since 2017, that is declining by tens of thousands of coins per month through ongoing accumulation, and that is actively being consumed by the existing ETF market, strategy, and corporate treasury buyers simultaneously. The BTC network analysis, cited in the supporting document provided for this video, published a table documenting the specific demand-supply collision. 1% equals approximately $93 billion and 1.1 million Bitcoin, using the broader $9.3 trillion base. 2% equals $186 billion and 2.2 million Bitcoin. That second number, 2.2 million Bitcoin at 2%, equals the entire exchange reserve supply. The supply does not run out in the sense that the market closes or Bitcoin becomes unavailable. The supply runs out in the sense that price discovery begins to occur at a velocity that front-runs the demand itself, because buyers who understand that 1.1 million Bitcoin of demand is coming for a pool of 2.2 million available coins will position before the allocation, because every institutional allocator in the market reads the same filing documents that this channel is reading right now. This channel has emphasized the distribution model distinction throughout this video, but Block 7 will make the structural argument with the precision it deserves. The 9 existing US spot Bitcoin ETFs entered the market through the same distribution pathway. They filed with the SEC, received approval, and then marketed their products to broker-dealer platforms, registered investment advisor networks, and individual financial advisors at firms that were not their own. Every dollar of inflow required convincing someone external to recommend the product. This is why IBIT's $50 billion accumulation in 11 months was described as unprecedented, because it had to generate that demand entirely through external distribution channels that BlackRock had to activate one advisor conversation at a time. Morgan Stanley's distribution model is categorically different for one specific reason. MSBT is a product issued by the same institution that manages the money and employs the people who recommend it. A Morgan Stanley financial advisor recommending MSBT to a Morgan Stanley client within a Morgan Stanley managed account has zero institutional friction. There is no compliance review comparing an external product against an internal standard. There is no fee justification explaining why a competitor's product is appropriate. There is no revenue sharing negotiation between Morgan Stanley and an external ETF issuer. The product is in-house, the fee is the lowest on the market, and the advisors have already been authorized since October 2025 to recommend Bitcoin to all clients, including retirement accounts. FIMEX's analysis of the MSBT filing stated this dynamic precisely. MSBT solves that problem for Morgan Stanley's $5.5 trillion, and that is the part most people are underestimating. Even conservative assumptions produce meaningful numbers. The Blockchain Council analysis confirmed the distribution advantage explicitly. Morgan Stanley's approach targets those constraints with a fee structure that undercuts existing competitors. A lower-cost in-house product could allow those advisors to allocate to Bitcoin without recommending third-party funds. The speed of deployment is the variable that determines whether the supply shock is acute or gradual. If Morgan Stanley's 16,000 advisors gradually introduce MSBT into client portfolios over 12 to 24 months, the slow deployment scenario, the supply shock is gradual, the price discovery happens over time, and the signal appears in on-chain data before it becomes visible in price. If some portion of the advisor network moves quickly, responding to client demand, competitive pressure from other advisors at the firm, or a macro catalyst that makes Bitcoin allocation conversations easier, the speed of capital deployment compresses the supply shock timeline. The IBIT precedent is informative here. BlackRock's external distribution produced $471 million in a single day during extreme fear conditions on April 6, 2026, confirmed by CoinDesk and Farsight investors. Despite war headlines, despite 46% Bitcoin drawdown from ATH, despite zero expectation of near-term Fed cuts. That is external distribution, one firm among many, one product among 11, in the most hostile macro environment of the year. Internal Morgan Stanley. Distribution of a proprietary product in a normalized macro environment is a structurally more powerful delivery mechanism. This channel has an editorial commitment to presenting bear cases with equal precision to bull cases, and the bear case on the MSBT supply shock thesis is substantive and requires honest engagement. Femex's analysis of the MSBT filing included a direct caveat. Joe Takayama of Backpack cautioned that actual allocation could be below 2% or even close to zero. BitGet's analysis noted, as of early 2026, about 80% of crypto ETF adoption on Morgan Stanley's platform comes from self-directed investors, not advisor-managed accounts. The advisory channel is where the real growth potential sits, but it has not yet been meaningfully activated. The filing is for a new product. The authorization to recommend Bitcoin to all clients was only extended in October 2025. The advisors have the permission, but not yet the habit, and institutional culture changes slowly. The regulatory pathway also introduces uncertainty. The SEC declared the registration effective, but final operational clearance is subject to procedures that can introduce delays. Crypto Briefing confirmed that the SEC declared MSBT effective and Morgan Stanley filed its final prospectus, suggesting imminent launch on April 8th. But imminent, in regulatory contexts, has occasionally meant weeks rather than days, and MSBT has not yet actually begun trading as of this recording. Additionally, the Iran war macro environment, Brent crude at $111 per barrel, the Federal Reserve on hold, the crypto fear and greed index at 13, represents precisely the kind of risk-off environment in which advisors are most cautious about introducing new asset classes to clients. The argument that institutions buy the dip is validated by $471 million in ETF inflows on April 6th. But an advisor adding Bitcoin to a client's managed account during a period of extreme fear faces a different calculus than an institutional allocator deploying from a dedicated fund. The Goldman Sachs, JP Morgan, and Bank of America counter-narrative is also real, and this channel states it plainly. Femex's analysis identified that if MSBT is approved, it establishes a precedent for other major banks to follow, and BitGet noted, Goldman Sachs, JP Morgan, and Bank of America all have wealth management divisions with trillions in client assets. If those firms begin filing their own bank-issued Bitcoin ETFs, a process that takes months, the demand side of the equation does not just add MSBT's potential. It adds every major U.S. wealth management network's potential simultaneously. That scenario amplifies the supply shock thesis rather than refuting it, but it also suggests that the timeline is not the launch of MSBT tomorrow. It is the 12 to 24-month period during which the institutional Bitcoin ETF ecosystem transitions from asset manager-issued products distributed externally to bank-issued products distributed internally. MSBT is the first product in that transition. It is not the entire transition. Every data point in this video needs to be understood within the context of the halving cycle timing, and this channel will make that argument with precision because the timing is not coincidental. The April 2024 halving reduced daily Bitcoin issuance from 900 Bitcoin to 450 Bitcoin. Over the subsequent 12 months, approximately 164,000 Bitcoin entered circulation through mining, the entire annual supply. Against this, the U.S. spot Bitcoin ETF market has been accumulating Bitcoin at rates that far exceed new mining issuance on a normalized basis, even accounting for the significant net outflows in Q4 2025 and Q1 2026, following Bitcoin's all-time high. The historical halving cycle thesis, validated across 3 prior halvings in 2012, 2016, and 2020, holds that the most significant price appreciation occurs in the 12 to 18 months following the halving event. approximately the window that began in October 2024 and extends through October 2026, according to the cycle timing this channel documented in prior videos. Bitcoin reached its current cycle, ATH, of $126,000 on October 6, 2025, 17 and a half months post-halving, before retreating 46% to approximately $68,000 by April 2026. The correction, extended and deepened by the Iran war's suppression chain, has occurred precisely within the window where the halving cycle analysis suggests major accumulation by well-capitalized investors who understand the structural setup. BitGo's analysis noted a data point that directly supports this accumulation thesis. Dormant coins are accumulating faster than new coins are being minted, which means Bitcoin's usable supply is shrinking on a net basis. According to a recent report by Fidelity Digital Assets, using data from Glassnode, more than 566 Bitcoin per day are aging into the ancient category, defined as coins that have not moved on-chain in over 10 years. By comparison, miners now produce only 450 Bitcoin per day, following the 2024 halving. Read that sentence carefully. 566 Bitcoin per day are aging out of the tradable supply, moving into the ancient category of coins that have not moved in over a decade and are highly likely to be held permanently. Miners produce only 450 Bitcoin per day. The net flow of Bitcoin into permanent liquid status already exceeds the daily new supply by 116 coins per day, every day, before accounting for a single dollar of ETF demand, strategy accumulation, or MSBT allocation. The Bitcoin supply is contracting in absolute terms in 2026 at the most critical structural moment of the halving cycle. This is the environment into which MSBT's potential $62 to $93 billion of demand is entering. Understanding how fast institutional Bitcoin demand can materialize requires looking at the only precedent available, BlackRock's IBIT, which launched on January 11, 2024, and became the subject of the most detailed public documentation of institutional ETF demand speed in market history. IBIT accumulated $10 billion in assets in approximately 50 days, the fastest any ETF had ever reached that milestone in any asset class. It reached $50 billion in 11 months. 5 times faster than the next fastest ETF, which was BlackRock's own iShares Core MSCI EF ETF, and took nearly 4 years. Net inflows in IBIT's first year exceeded $52 billion, according to CoinDesk's November 2025 report. Nate Gerasi, president of the ETF store, described it as the greatest launch in ETF history. James Seifert of Bloomberg Intelligence stated, IBIT's growth is unprecedented. It's the fastest ETF to reach most milestones, faster than any other ETF in any asset class. IBIT achieved all of this through external distribution, convincing financial advisors at other firms to recommend BlackRock's product. Morgan Stanley contributed to those flows, but was distributing someone else's product with someone else's branding at someone else's fee rate. MSBT changes all 3 of those variables simultaneously. It is Morgan Stanley's own brand at the lowest fee in the market, distributed by Morgan Stanley's own advisors to Morgan Stanley's own clients. The friction reduction is not incremental, it is categorical. FEMEX's analysis described the bottleneck that MSBT removes. The bottleneck for Bitcoin ETF adoption has never been product availability. There are already 11 spot BTC ETFs on the market, and combined daily trading volumes regularly exceed $20 billion. The bottleneck is distribution, specifically getting Bitcoin exposure in front of the trillions of dollars managed by advisors who have never proactively offered it to a client. MSBT solves that problem for Morgan Stanley's $6.2 trillion. If MSBT captures inflows at even 10% of IBIT's first-year pace, $5.2 billion in the first year, it removes approximately 76,000 Bitcoin from exchange supply at current prices. If it matches 25% of IBIT's pace, $13 billion in the first year, it removes approximately 191,000 Bitcoin. If it performs at IBIT's actual pace, $50 billion in 12 months, it removes approximately 735,000 Bitcoin from a total exchange reserve pool of 2.2 million in a single year from a single product. And here's the final piece of context that closes the argument. BlackRock had to build IBIT's distribution network from scratch, one advisor conversation at a time. Morgan Stanley has 16,000 advisors who are already sitting across the table from the clients. The title of this video is not a prediction about tomorrow's price. It is a description of a specific market dynamic that occurs when institutional demand is large enough to absorb the liquid supply before price discovery has fully occurred, a phenomenon that the first principles analysis of Bitcoin's current supply architecture suggests is structurally possible for the first time in the asset's history. This block will explain the mechanism. Bitcoin's price discovery operates through the order book. the live collection of bids and asks on centralized exchanges that allows buyers and sellers to meet and transact. When large buy orders hit exchange order books, they consume ask-side liquidity, driving the price to the next available seller. The deeper the order book, the more capital is required to move the price a given percentage. Bitcoin's order book depth has become progressively shallower as exchange reserves have declined from over 3 million Bitcoin in 2021 to approximately 2.2 million today, and as the proportion of that reserve held as genuine sell-side inventory, rather than market maker operational float, has shrunk correspondingly. CoinDesk's order book data and the supply-demand framework documented in multiple analyses confirm that the available depth to absorb large institutional buy orders without meaningful price impact has contracted substantially. The specific dynamic described in the title, supply running out before price reacts, refers to a scenario where institutional demand is channeled not through the exchange order book, but through the ETF creation mechanism, which uses authorized participants to purchase Bitcoin from OTC desks and prime brokers rather than directly hitting exchange spot markets. This mechanism allows large volumes of Bitcoin to be absorbed without immediately appearing in exchange price data. The effect on price is therefore delayed, which is precisely what supply runs out before price reacts means. $62 billion of MSBT demand does not appear on the Bitcoin price chart on April 8th as a vertical spike. It appears over weeks and months as OTC desks absorb available supply, OTC depth depletes, and eventually the price discovery mechanism is forced to reflect a supply-demand imbalance that has been building in the plumbing of the market long before it becomes visible on the chart. The supply tightness is already structural and documented. MSBT is the demand catalyst that turns a structural setup into an active event. This channel does not give price targets. What this channel does is give architecture, the structural analysis of documented forces operating on a specific market, and let the mathematics speak. The architecture of the MSBT supply shock thesis, assembled from public sources and verified data, is as follows. Morgan Stanley has $9.3 trillion in combined wealth and investment management assets, with approximately $6.2 trillion in advisor-managed accounts according to Blockchain Council, and 16,000 financial advisors who have been authorized since October 2025 to recommend Bitcoin to all clients. Morgan Stanley filed its final S1 amendment on April 3, 2026, with Bloomberg's Eric Balchunas confirming launch expected April 8th. MSBT will be the lowest cost spot. Bitcoin ETF in the U.S. market at 0.14%, issued by the first major U.S. bank to create its own proprietary product, rather than distribute to third parties. 1% of the conservative $6.2 trillion advisor base equals $62 billion, 850,000 Bitcoin at current prices. Against a total exchange reserve of 2.2 million Bitcoin that is the lowest since December 2017, declining by tens of thousands of coins per month, being simultaneously consumed by the existing ETF market, by Strategy's 850+ thousand coin treasury, and by the structural illiquidification of approximately 70% of all circulating supply, the total liquid Bitcoin available for purchase without meaningful price impact, considering exchange reserves, OTC depth, institutional prime broker inventories, and genuine sell-side availability, is estimated across multiple sources at $20 to $40 billion at most, according to the supporting analysis provided to this channel, against potential MSBT demand of $60 to $93 billion from a single 1% allocation at a single institution. The supply does not run out because Bitcoin disappears. The supply runs out because the available for purchase inventory is insufficient to meet the demand without prices rising to attract more sellers. And in Bitcoin's current supply architecture, where 70% of circulating supply is illiquid, 3 to 4 million coins are permanently lost, and exchange reserves are at 7-year lows, the price required to attract sufficient sellers from cold storage and long-term holders is substantially higher than current prices. The mathematics does not tell this channel when. The mathematics tells this channel that the physics of the situation have a specific direction, and the architecture is already assembled. The people who understand Bitcoin's supply structure before the demand event materializes are positioned in a fundamentally different place from the people who understand it after. IBIT was the first event of its kind. MSBT is structurally more powerful. The Goldman Sachs and JP Morgan products that follow, if and when they file, will compound the dynamic. And all of it is operating against the most supply-constrained Bitcoin market in the asset's 15-year history. You have the map. The supply constraint is documented. The demand catalyst is registered with the SEC and launching tomorrow. And the people who read the on-chain data before the ETF ticker activated have already been accumulating while the rest of the market was watching war headlines. No price targets, no financial advice. Do your own research, all data sourced and verified. Full source list in the pinned comment below. To those of you reaching this final checkpoint, respect. You've just completed a masterclass in institutional mechanics. Your attention span is officially institutional grade. In an era of dopamine-driven distractions, your ability to focus on 12,000 words of pure data is your greatest unfair advantage. You don't just watch the price, you see the architecture. Here is your final directive. To signal that you are part of the elite 1% who finished this entire investigation, comment the code DIAMOND160 below. This is our internal handshake. It tells me who the true researchers are in this community. See you in the next one. Take care.